It's the first working day of the week. Many thanks for joining us on Business Morning. I am BC Adebayo. Oil prices are trending higher today on tighter supplies from major producers, but concerns that the record rise in global coronavirus cases could curb a recovery in fuel demand checked gains. Brent crude was initially trading at $42.28 a barrel before declining slightly to $42.10, while U.S. crude was at $39.53 a barrel. Both contracts rose about 9% last week, and Brent crude futures flipped into backwardation, where oil for immediate delivery costs more than supply later, usually an indication of tightening supply. In the United States and Canada, the number of operating oil and natural gas rigs fell to a record low, even as higher oil prices prompt some producers to start drilling again. Iraq and Kazakhstan pledged to comply better with oil production cuts during an OPEC panel on Thursday. However, OPEC Plus group, consisting of Organization of Petroleum Exporting Countries and its allies, including Russia, has yet to decide whether to extend a record supply cut of 9.7 million barrels per day for a fourth month in August. Of course, we'll continue to bring you updates on the oil markets as they come. And now, the Corporate Council on Africa has organized the virtual Corporate Council on Africa Leaders Forum with the theme Resilient U.S.-Africa Business Engagement to Drive Post-COVID-19 Recovery. This virtual forum will take place this week, starting tomorrow through Friday the 26th. And to shed more light on this, I'm being joined by the President and CEO, Corporate Council on Africa, Forizal Leza. Good morning, and thank you for joining us on the program. Well, let's begin this conversation with you telling us why this forum on U.S.-Africa has become imperative at this time.
Well, thank you so much for inviting me to speak. We know that COVID-19 has been rapidly spreading across Africa. We realize, though, that to fight COVID-19 and also to prepare for post-COVID-19 economic recovery in Africa, which is so critical, that we couldn't just wait. We needed to bring together U.S. and African leaders, both from government and from private sector. And so our Leaders Forum is something that we're pulling together so that we can shine a light on Africa, on the opportunities in Africa, some of which will be new because of COVID. Last year, we had our U.S.-Africa Business Summit in Maputo, Mozambique. And this year, in fact, about 2 weeks ago, we would have held our annual U.S.-Africa Business Summit in Marrakesh, Morocco. But because we could not do that, we thought we still must convene all of the leaders that we can. And so we're very pleased that as a part of our Leaders Forum this coming week, as you said, Tuesday through Friday, we'll be shining a light on different aspects of resiliency in the U.S.-Africa business relationship. We'll be looking at the financial ways to address economic recovery in Africa. We'll be looking at health issues. We'll be looking at trade as drivers of economic growth on the continent. And we're so pleased that we have 4 African heads of state that have already confirmed their participation. So over the next 4 days, we'll be welcoming President Kagame of Rwanda, President Nyusi of Mozambique, President Kenyatta of Kenya, and President Akufo-Addo of Ghana. In addition, we'll have a number of CEOs from both U.S. and African companies that will be joining us, and high-level officials from the U.S. government as well.
Would Nigeria be in any way represented?
Well, we have invited them. We are still crossing our fingers and hoping that His Excellency, the Vice President Osinbajo of Nigeria, will join us. I've had the pleasure of meeting with him before. He knows Corporate Council on Africa and has participated in previous events that we have done. And so cross our fingers, and maybe you can put in a good word for us, or maybe if he sees this today, Vice President, we would love to have you join us. So yes, we are definitely hoping that Nigeria will be at the table for this important conversation.
We'll see how that goes. The Trump administration seems to be more focused on bilateral relation as opposed to multilateral relation. In terms of investment now, Where does America want to position itself as long as Africa is concerned?
Well, you know, this is a perfect time for the U.S. to be focused on how we can advance our economic relationship with Africa. The African Continental Free Trade Area that has been launched will create the largest free trade market in the world. And in Africa, there'll be a growth of about 70% annually of consumer spending over the next 10 years. It'll amount to over $6.7 trillion. And we also know that the youth population of Africa is so large and is also playing a critical role in terms of entrepreneurship in some sectors that are growing there faster than any others. In terms of internet, the digital economy. And so this is a perfect time for U.S. companies. We're there. There are a lot of U.S. companies that are there. Many of CCA's members, like GE and Procter and Gamble and Caterpillar, have been there for many years. And then there are new companies that people don't hear about, like Acro Bridge, that's building infrastructure across the continent. And has some new things that they'll be doing in Mozambique and other countries as well. So this is a perfect time for U.S. companies to look at Africa and to see what are the growing opportunities, the new opportunities for engagement there.
Now, talking about US-Africa trade relations now, they've been governed for the past 20 years by the Africa Growth and Opportunity Act. But would you say that AGOA has really worked for African countries?
Well, the answer to that is yes, but has it done all that it could, all that we would like it to? No. So there are approximately 5 years left to AGOA. I think it's really important that the Africans are continuing to try to take advantage of AGOA's market access to the U.S. We're a huge market. The majority of their products can come in duty free. And a number of countries, we hear about the countries that are shipping oil, for example, like Nigeria, but Nigeria is shipping other products as well to the U.S., value-added products, agricultural products, shea butter products, etc. So we don't hear about that as much. We don't hear about Kenya that's now shipping $500 million worth of apparel to the U.S. every year, as well as footwear coming from Ethiopia. Many of the stores you're going into in the United States are selling products that are made and produced in Africa and benefiting from AGOA. But because AGOA will likely be phasing out at the end of this 5 years coming up in 2025, this is also a good time to look at new opportunities and new ways for Africa to engage with the U.S. in terms of its trade relationship. And we're really pleased at Corporate Council on Africa that we're looking at things like a free trade agreement, which will be a model. This is one with Kenya. This can be a model for what is happening in East African regional integration, as well as supporting the African Continental Free Trade Area in terms of how the Africans can better integrate themselves into global value chains, and U.S. companies trading with Africa and developing new platforms for engagement, such as trade arrangements, bilateral investment treaties, etc. These are ways that Africa can take its current trade relationship with the United States to another level. Let me just also mention that there are several U.S. government programs that are relatively new. Prosper Africa, which is a whole of government approach where 17 different U.S. government agencies are all working together now to try to support U.S. companies who are doing business in Africa and want to do business in Africa. And so Prosper Africa is a new initiative. And then we are also really excited about the fact that the Overseas Private Investment Corporation, it used to be called OPIC, has now become the Development Finance Corporation. And DFC has doubled the amount of resources that will be available to companies doing business in the continent. U.S. and African companies partnering together in joint ventures. They'll have about $60 billion, and they'll also be able to do equity loans, which they were not able to do previously. So again, even though it may seem like the U.S., both the government and the private sector, are not there on the continent, that's really not true. They really are, and there are new opportunities to do even more.
And speaking of opportunities to do even more now, what would you say is the way forward as long as U.S.-Africa business relation is concerned?
So I think the way forward is to look at some key sectors. I think that in the African Continental Free Trade Area, they're opening up now as much as 90% of trade in goods. They also are looking at liberalization of the market in services trade, which is really important in Africa. The services sectors, telecom services, banking and financial services, distribution services. These are really key on the continent, and they are also key for U.S. companies who want to do business there and need to have the infrastructure, the kind of connectivity, access to the latest and best financial platforms, which Africa is really providing more than other places. I first came across mobile banking on trips to Africa before it was even available here in the United States. So there's some sectors like that which we believe are really going to create opportunities for economic recovery from COVID, and companies can engage.
What would you say are the potential impacts of the African Continental Free Trade Agreement on U.S.-Africa trade agreements?
Well, as I said earlier, the African Continental Free Trade Area, from our perspective, is a game changer. I think many of you know that Africa is composed of 54 countries. There are many markets that are small and landlocked. And so creating this new free trade area, as I said, the largest one in the world, where goods can move freely, goods and people and services can move freely across borders in Africa, but also make it possible for Africa to trade and engage with the global economy more effectively. And so we see the AFCFTA as really critical. We have lots of companies that are asking questions about, like, how can we be a part of this? How should we position ourselves, CPA, so that we can take advantage of this new market? And we believe that that will be an opening for companies who weren't sure, do I go to this small economy here or this small economy here, or even the larger economies like Nigeria? Will it give us access to all of the ECOWAS countries in West Africa? Now, with the AFCFTA, companies know that they can come, they can invest in one place, and they will be able to basically engage with, trade with the rest of the continent. And this is really critical. And again, we see this as a game changer.
How can African governments engage in a coordinated response to meet the needs from COVID-19 in Africa?
A new response to what?
To COVID-19 in Africa.
I'm sure I'm not hearing the creative word.
No, I was asking that how can African governments actually engage in a coordinated response to meet the needs from COVID-19 here on the African continent?
Oh, yes. So I think that African governments are really in need of collaborating and working together closely. No one country by itself is going to be able to overcome COVID. This is something that doesn't respect borders, obviously. And it's going to be critical that there be engagement amongst themselves, coordination, collaboration. And there are efforts that are being put in place by the African Union so that Africans can indeed work together effectively amongst themselves, but also with the global community. So there have been efforts, I know some that are being led by the African CDC, others by UNECA and so forth. And that ability to come together and also to approach the Western world and their partners from all over the world, frankly, in terms of what it is that Africa needs, what the governments need in terms of support, what the private sector needs in terms of support, so that Africa's economic recovery can move forward smoothly and effectively.
All right, at the end of this forum now, how do you hope to ensure the implementation of some of the outcome of this forum?
I'm sorry, I'm having a hard time hearing you.
I was asking that at the end of the forum now, how would you be able to track the implementation of some of the recommendations that would be made at the end of the forum?
Yes, thank you. Thank you so much. I think that one of the things that CCA has been well known for in our 27 years, I didn't say before, but we are a nonprofit business association with both U.S. and African members and companies that are multinationals as well as SMEs. And by providing the access, connections, and insights that businesses need to be successful when they are doing business on the continent, we've been able to enhance business relationships between the United States and our partners on the continent. And at the end of our Leaders Forum, we will be taking the information that has been shared. We have some really high-level panels with some top people, CEOs of different companies, heads of organizations, like UNECA. We have one of the AU envoys that has been appointed by President Ramaphosa. And what we will be doing is gathering up all of the information that comes from the 4 panels, high-level panels that we have on the 4 topics we'll be discussing. And we will be sending out information about some of those things that come out in those sessions. And then it's our plan that as we move towards September, we're all looking to see whether or not the UN General Assembly will happen as it always does. But whether it happens in person in New York or it happens virtually, Corporate Council on Africa plans to use UNGA as an opportunity to follow up on some of the things that we know will be heard this coming week during our Leaders Forum.
We would like to thank you, President and CEO, Corporate Council on Africa, Florizel Lisa, for taking time to speak with us on Business Morning.
Thank you so much to Channels TV for having me.
All right, let's just do a quick recap of the crude oil prices. Of course, they're trending higher this morning on tighter supplies from major producers, but concerns that a record rise in global coronavirus cases could curb a recovery in fuel demand actually checked gains. We saw Brent crude initially trading at $42.28 a barrel before it declined to about $42.10, and U.S. crude was at $39.53 a barrel. Now, we've seen Boge contracts rise about 9% last week, and Brent crude futures flip into backwardation. That means that oil for immediate delivery costs more than supply later, usually an indication of tightening supply. In the United States and Canada, the number of operating oil and natural gas rigs fell to a record low, and that came even as higher oil prices prompted some producers to start drilling again. Of course, Iraq and Kazakhstan also pledged to supply better with oil production cuts during an OPEC panel on Thursday last week. And the OPEC Plus group, which consists of Organization of Petroleum Exporting Countries and its allies, including Russia, is yet to decide whether to extend a record supply cut of 9.7 million barrels per day for a 4th month in August. Still to come on the program, a discussion about one of the critical sectors for Nigeria post-COVID-19. Do stay with us. Welcome back. Gas has been highlighted as one of the several sectors critical to post-COVID economic recovery, and Nigeria is one of the countries with the largest gas reserves in the world, but we're yet to tap into the great potentials of our gas reserves. Nigeria declared the year 2020 as the year of gas, but what does this mean in reality? Well, I'm being joined by the Chief Executive Officer, Frontier Oil, Mr. Dada Thomas, to answer this question and more. Good morning, Mr. Thomas. Thanks for joining us on the program. So Nigeria is the 9th largest country in terms of gas reserves in the world. But how come the country is failing or has failed, as in the past, to pull its weight in the league of gas producers like Qatar, for instance?
Bisi, good morning, and thank you for having me on this program. It's an interesting question, and the answers are many. But I think the big picture is that unlike Qatar, which has 4.5 times the gas reserves of Nigeria, we haven't taken gas quite as seriously as we ought to have. And I mean that in the sense of that, for instance, Qatar, in less than 40 years, developed an LNG project that is about 3 times bigger than that of Nigeria. Qatar has made swift decisions, investor-friendly decisions, which has attracted investments to ensure that it has a world-class gas enterprise, which is able to, of course, benefit its population and its citizens. Qatar has a GDP of $124,000, let's say in 2017, compared to $2,500 of Nigeria. Of course, population has a large role to play in that, and they have larger reserves. But we have not done what we ought to have done with respect to gas. We could have done a lot more. We did a few things in the past. We enacted a few decrees during the military era, which led to very successful projects like the Bonny project, the Chevron Excravos gas to liquids project, the West African gas pipeline. But we could have tens of those things. We should have had tens of those things, not just the singular projects. So we're sitting on the 9th largest reserves in the world, as you mentioned earlier on, but we're sitting in darkness. We generate less than 5, or we distribute less than 5 gigawatts of power a day to 200 million people. Yet we're sitting on the 9th largest reserves. So we, as a country and as a nation, need to really now take hold of our resources and turn that valuable resource into a resource that can catalyze economic development and help to improve the standard of living and industrialize Nigeria.
But what are some of the recommendations you would actually give?
Well, I mean, look, we've been talking for 40 years, BC, about gas. When I was a young engineer, we were talking about gas. Now I'm an old man, with more than 40 years experience in the oil and gas industry. We're still talking about gas, and the disaster, we're saying exactly the same things we were saying 40 years ago. Okay? To move forward, there are a few key things that need to be done in Nigeria. The first is very simple. Let us put in place the policy and legislative framework that would ensure that investors are happy to come and invest in the gas business in Nigeria. So one of the things that we can achieve as a nation, hopefully this year, according to the National Assembly, is that they will pass that thing called the PIB, the Petroleum Industry Bill. They claim they will pass it by September. And if within PIB, they entrench investor-friendly win-win fiscals that will encourage gas investment, that is the first thing. The second thing is this, that bedazzling gas over the last 40 years is the fact that everybody complains that the price is too low, although the price has shifted over the last 10 years. Price for gas has been regulated by fiat, essentially, in Nigeria. We do not believe that's the way to go. We believe that we need to migrate to what we call a willing buyer, willing seller, market-driven market, where two parties can sit together and contract with each other to, I'll sell you gas, I will buy your gas, and we're both happy about the pricing. I assure you that if that is allowed to happen, we'll have more gas and we can know what to do with. The other thing, which again has been a perennial problem, is the lack of infrastructure for moving gas from where it is produced, largely in the Niger Delta of Nigeria, to where it is consumed, largely in the southwest of Nigeria and other places. Infrastructure investment is extremely expensive. And a lot of work has been done or is being done, but it is not enough. We need 10 times more gas transportation and distribution infrastructure than we have at this point in time. But some good things are happening. For example, the AKK, the Ajaokuta Kaduna-Kano pipeline is ongoing. The Oban Obi and Obi pipeline called the OB3 is nearing construction, although it's now delayed to 2021. And the Lagos Escravos pipelines, which feeds the gas from the Niger Delta all the way to Lagos, is essentially being doubled in capacity. Those are good things, but we still need a lot more infrastructure. And the best way to do this is that the government needs to partner with the private sector where the money is lying to ensure that these projects can get done. And then the elephant in the room, that huge elephant in the room, which has been a very disruptive factor for the gas sector and the entire gas to power sector, is that the power sector is adversely impacting the gas sector because the power sector is essentially an illiquid, it's essentially a dead sector in Nigeria, and it owes huge amount of money to all its upstream suppliers. It owes money to the generating companies, who in turn owe a lot of money to the gas producing companies. We're talking debt, that ranges nearly a trillion naira. Nobody really knows how much is that bad. And that debt is crippling everybody who are in the gas to power value chain, especially the gas producers who have taken tremendous risks, investing hundreds of millions of dollars generally in a typical project, and then they're not getting paid for the gas they supply. Many of them have invoices for gas that are 2 years old, and there's nobody to truly address when they're going to be paid. So that's a huge elephant in the room. And the other recommendation I would make is that there's a huge forex exchange exposure that gas sector is exposed to. The gas sector is generally a dollar investment business. You take hundreds of millions of dollars, and in many cases, it can be as much as billions of dollars. You invest it in a gas production system, and then when you sell your gas, you're paid in naira. Unfortunately, you're not paid in naira at the market rate. You're paid in naira at the CBN rate. And generally, most people lose 20 to 30% of their invoice value on FX exposure. This is not a good thing, and it's not an incentive for investing in the gas business in Nigeria. So I think those are just a few simple recommendations that could drastically change the gas picture in this country. And we need to change that narrative for the simple fact that the president committed to uplifting 100 million Nigerians out of poverty in the next 10 years. I believe and I subscribe to that. The Nigerian Gas Association, of which I used to be the immediate past president, subscribes to that. But how do you do it? I think that utilizing our gas properly is one of the keys to truly unlocking the economic potential of Nigeria and to ensure that we can create local value addition so that we can provide employment for the hundreds of millions of people that this country will become in the next 30 years. We're now 200 million people, and we're projected to double in population in the next 30 years. How are we going to provide jobs for them? How are we going to feed them? How are we going to move them around? How are we going to clothe them? I think that gas is the key to that. It's one of the key to the solutions to that problem.
Now, one of the striking things you said now, is the fact that, of course, power remains the huge elephant in the room. But some also attribute the power problem to a failure to invest in the gas sector. So do you in any way believe that solving the gas problem could also be a major milestone in solving Nigeria's acute power shortage?
I totally disagree that it is lack of investment in the gas sector that is the problem of the power sector. The gas to power sector is a chain. It's an intricately woven, interdependent chain in which if there's a weak link in that chain, then the entire value chain is weak. I'll give you a good example. There is no problem for anybody investing in an export gas project. The reason is very simple, BC. You invest in dollars, you will sell your product in dollars, you will sell your product to credible, bankable off-takers who will pay you your invoices as at when due. Now, take the domestic sector in which 80% of the demand for gas is from the power sector. And remember, I did say that the power sector is essentially a dead, illiquid, insolvent sector. You invest in dollars and you get paid in naira, and they don't pay your invoices. So the entire value chain is broken and needs to be fixed. Totally. No, you can't fix it. Band-Aid cannot fix this problem. We need to radically restructure it to make sure that the sick animal in that chain, which is the power sector, and ultimately the distribution element of that sector, is fixed. That investment is made by the 11 discos in this country to upgrade their infrastructure, that they can upgrade their ability to collect their monies from the consumers, which is channels, which is me, which is you, and that they can ensure that the money efficiency of collection is so high that they can remit the money back up the value chain to all the people who supplied that value chain. If we can fix the power sector, and the key to fixing the power sector are many, but the key one is that the price we pay for electricity is not market reflective. The money we pay per kilowatt hour is not enough to sustain the value chain. And Nigeria has been playing the ostrich game about this issue of solving and addressing the power tariff. Now, essentially has not been able to do the job it should have been doing for years because too much. The whole process was politicized. You can even you do realize that the price increase that was supposed to have taken place is being postponed again, I believe, to July. Okay, the elements of calculating how you increase electricity tariff include foreign exchange, include the price of gas. But those things have not been properly addressed, and we're in a country where we're paying very little for grid power, yet we're paying 2 to 3 times for self-generated power. And we can't see the common sense in paying for quality 24-hour reliable power just by paying a bit more for the tariff. If we paid more for electricity tariff, we will get power, people will invest, and the gas sector, which is owed a lot of money, would be able to invest further in gas supply systems for this country. So the gas producers and the suppliers are not the problem. It is the downstream end, it is the power sector that is the problem in this country. But as I did say earlier on, it is a chain, and every part of that chain needs to be working at 100% efficiency for the value chain to deliver quality power to the end consumers, and therein lies the problem. The problem is being addressed in silos, not as an intrinsic, holistic problem.
Chief Executive Officer, Frontier Oil, Mr. Dada Thomas, thanks a lot for speaking with us on Business Morning.
Thank you very much, Bisi. Have a good day.
All right, it's now time to review the equities market numbers, and the Nigerian Stock Exchange suffered a second decline in 3 weeks as investors dumped market giants Dangote Cement, MTN Nigeria, and Nigerian breweries. Of course, this was attributed to several factors, including the fact that investors are maintaining a cautious portion on their appetite for stocks over fears of a second wave of the coronavirus pandemic. And these fears pushed all-share index lower by 0.99% week on week as the markets witnessed 4 sessions of losses out of 5 trading days for the week. And that brought the year-to-date return to minus 1.72% from minus 7.5% in the previous week. And this also impacted the volume, the value, and the deals, which were not so impressive throughout the week, as 1.05 billion shares worth 10.12 billion naira changed hands in 19,576 deals. Analyzing by sectors now, we saw significant losses recorded in the oil and gas, insurance, and the banking sector, which weighed on market performance as all the 3 indices declined. Well, let's talk to a stockbroker, Rotimi Fakayijo, for more on what happened last week. Good morning, Mr. Fakayijo. Thanks for joining us on the program. I know you were quite optimistic last week despite the losses, but should we expect the market to return to winning ways this week with the increasing number of COVID-19 cases in Nigeria and weak economic conditions?
Well, it's most unlikely that we'll begin to see positive figures because when you look at it, look at last week's activities critically, you can see that the daily average value was 2 billion naira, and that is quite unlike the market. And so, for that reason, like just as you have mentioned earlier on, the risk appetite for shares has really reduced, and investors are taking a lot of caution. Even outside this jurisdiction, the global markets as well are very apprehensive of what effect the market could have. The pandemic will have, maybe if there happens to be a second wave of the lockdown. Now, everything seems to be so uncertain. So the only thing investors can do at this time is just to exercise a lot of caution. And we see that coming up with a highly capitalized stock bearing the brunt first before it begins to spill over to other securities.
Give us an overview of today's trading so far. Are we seeing any difference yet?
Well, I think what is actually in the market today, I think a total of about 280 million naira value has been traded, and the market is still neither positive nor negative, so it's still very flat. And among the small gainers that we can see presently is Fidelity Bank. So I believe that the caution still continues, and I think the investors may not really be too aggressive to do a sell-off. So for that reason, we may see a sparing gain in the market at the end of the day.
What about Dangote Cement, which actually lost on Friday? Of course, that was the major drag to the index. Has there been any significant changes at this morning?
Well, I think for Dangote Cement, this trend is recurring in the sense that every now and then, when we see a major loss coming from that particular stock, there is every likelihood that the next 2-3 trading days we will see a rebound. So I think that kind of thing is likely to happen this week, and that definitely will help the loss of the market. We see the all-share index turning around positively if that eventually happens as the trend has always been.
Fingers crossed, we'll have for a profitable trading day. Rotimi Fakayijo, stockbroker, thanks for speaking with us. All right, let's turn to the unlisted securities market now. There wasn't so much activity as the NASD OTC Security Index on market capitalization closed the trading week at 704.76 points and 517.69 billion naira respectively. A total of 9.12 million units worth 2.18 billion naira were traded in 4 deals. And moving to the fixed income market, trading at the FDN bond, the secondary market was bullish as investors covered loss bids at the primary market auction, and consequently, the average yield across instruments contracted by 72 basis points to close at 9.4%. Of course, in all, there were 64 deals worth at 8.67 million naira. And trading in the Treasury bill secondary market was bullish as average yield in the space contracted 47 basis points across the segments. Yield contracted at the Omo market by 13 basis points, 4.9%, following improved trading volumes, and the NTB market by 122 basis points to 2.2%. And that was as market participants covered loss bids at the NTB primary market auction. And at the close of trading on Friday, we saw 9 deals worth 1.67 7 billion naira. Now we'll be crossing over to our London studio to see what's happened this morning, as well as check the numbers from the debt and currencies market in just a moment. Please stay with us. Now let's cross over to our London studio where Juliana Olayinka is standing by to give us this morning's key business headlines. Good morning, Juliana. Trust you had a great weekend. Well, the government will introduce new measures today to protect businesses critical to public health from foreign takeovers. Do you by any chance have an idea what these new measures are all about?
Good morning, Bissy. Well, this is an interesting story, and I think the headline that the government wants to send out to the rest of the world is that they're open for investment but not exploitation. And this is really because, of course, as we all know, across the world, so many companies have been struggling due to the COVID-19 pandemic. Many companies that have staff here on furlough potentially won't be able to keep them employed when the government stops that scheme. And so now what the government are trying to say is that they want to make changes to the 2002 Enterprise Act, which will allow the government to intervene if any company has a turnover for £1 million and they are attracting interest from foreign investment. I believe one of the pressing situations which has made this come to the light again is that a UK company that makes component chips for Apple was to be taken over by a Chinese-backed firm, and that really got backbenchers, MPs and other government members pretty alarmed, and they said it was a strategic move and that it was a hostile takeover from China, and they want to prevent this from happening again, particularly with companies that are involved in vaccine research and manufacturing protective personal equipment. Now, Alok Sharma, the business secretary, he was writing in the Mail on Sunday yesterday, and he also re-emphasised this point, saying, of course, Britain is open for investment, but they don't want to be victims of hostile takeovers by foreign companies that want to take advantage of the pandemic and of businesses that may be struggling by putting their money in and then using this information against Britain. So it's a really interesting story, and obviously there seems to be some backing behind it by MPs, and that's why we are going to see a change in that commission today.
Now, the former Chancellor, Alistair Darling, has urged the government to consider an emergency cut in VAT. But do you think that Rishi Sunak will consider this when he announces a package of measures in early July?
Yes, absolutely. It's been on the cards for some time now. VAT in this country, value-added tax, it stood at 20% since January 2011, and Alistair Darling, when he was the Chancellor during the 2008 financial crisis, I believe that VAT was lowered from 17% to 15% at that time for at least a year to try and encourage people to start spending again. The scheme is likely to cost the government in the short term about £21 billion, but it will encourage people to start spending. Now, Sajid Javid, the former Chancellor who resigned, which is why Rishi Sunak got that position, he also highlighted to the Chancellor that he believes value-added tax should be cut to about 17% for at least a year. But he went a little bit further and said that he also believes that national insurance contributions should be cut for employers to encourage people to start employing again. We already know that vacancies in the UK are declining month on month, and perhaps as well as getting people to spend by lowering the cost of products, you could also get people to employ by reducing the rate they have to contribute to the national insurance.
Now, lead us into the week. What does this look like, and what are the major things we should look out for this week?
Well, the FTSE this week started off in the red, not great, similar to what happened last week. The sentiment now for traders seems to be focusing on that second wave of infections. Before, the centre of this second wave of the outbreak was in North America and China, but now overnight, we're hearing reports of the rate of infection in Germany skyrocketing to the point where there are some suggestions that they could actually go back into some sort of a lockdown. Now it's closer to the shores. Britain are really concerned about that, which is why the FTSE opened on the red. Tomorrow, we are expecting an update from Prime Minister Boris Johnson about the 2-metre social distancing rule. There's been huge issues which have been raised by business lobby groups about the hospitality sector. When it does open, which we believe now will be on the July the 4th, some of them are saying it's just will be impossible for them to function if there is a rule of 2 metres. So there are suggestions that it should go down to 1 metre. But again, because of this perhaps second wave of infections, there will be cause for concerns for the Prime Minister. But we are expecting him to update us on that tomorrow. Then, of course, it's about that time of the month when we are starting to expect some PMI flash data, which is the Purchasing Managers Index. Tomorrow, I believe it's manufacturing for June, which is important, but I think all eyes are going to be on services, of course, because Britain is a services-based economy. 80% it contributes to GDP, and I expect that will be released before the end of the week.
Of course, we have our eyes on all of these developments, and we'll be waiting to hear from you. Thank you, Juliana. We'll see you at 1:30. And back home at the debt and currencies market, let's speak with a fixed income dealer at Access Bank, Ladi Bello. Good morning, Bello. Mr. Ladi Bello, thanks for joining us on the program. Well, can you give us an overview of last week's market performance?
Hi, thank you for having me. So last week we saw mixed sentiment in the market, especially within the Treasury bill space. We saw some counterparties, this is primarily offshore counterparties coming into the secondary market to offload some of their positions and try and refresh these same positions in the primary market. That's the OMO auction that was conducted on Thursday. Aside that, we saw a predominantly bullish week, both within the Treasury bills and the bond space. We saw OMO bills rallying from a high of about 6% to an average of about 5.6% on the long end bills. We also saw some interest on the Nigerian Treasury bills as well. We've seen most of the interest skewed towards the short and medium tenured maturities as some portfolio managers and asset managers try and manage their funds and keep it within the so bills that mature within 2020 and not beyond that. Within the bond space, it's been predominantly liquidity driven. So we're not trading fundamentals at the moment. We're seeing interest across the curve. Most of the interest we see are on the bills that are typically being off your account.
To thank Ladi Bello, fixed income dealer with Access Bank, for speaking with us. But just before we go, let's review activities at the Nigerian equities market once again. And the numbers, the market, of course, suffered a second decline in 3 weeks, and that came as investors dumped market giants like Dangote Cement, MTN Nigeria, and Nigerian breweries. And this was attributed to several factors, including the fact that investors are maintaining a cautious position on their appetite for stocks over fears of a second wave of infections of the coronavirus pandemic. And these fears pushed the All-Share Index lower by 0.99% week on week, as the markets, of course, witnessed 4 sessions of losses out of 5 trading days for the week. And that brought the year-to-date return to minus 1.72% from minus 7.5% the previous week. Of course, this also impacted volume, value, and deals that were quite unimpressive throughout the week. Also, 1.05 billion shares worth 10.12 billion naira exchanged hands in 19,576 deals. Looking at the sectors now, we saw significant losses in the oil and gas, insurance, and the banking sector, which weighed on market performance as all 3 indices declined. But let's hope that things get to turn around for good, just as stockbroker Rotimi Fakaijo had predicted. And that's where we end today's program. Thank you so much for watching. I am Bisi Adebayo.